Welcome to another video in which I will be providing some more free analysis and education for all of you. If you're new to the channel, I'm a top author on the TradingView platform as well as running an educational company and swing trading full-time. Without further ado, let's get straight in the video and provide some more free content and value for all of you. Make sure you watch the video until the end because there is a lot of value to be taken from it. Okay, so I want to give some updates on all the analysis that we made here on YouTube on the pairs that we have. So all the live analysis that I made here, I want to give some updates on it. So on CAD CHF, what had we spoke about in the last analysis here on YouTube? So what we spoke about was the fact that overall this pair was shifting from a higher high, from basically creating higher highs to creating lower highs. So basically shifting its environment and structure. And we also spoke about the fact that overall the market was basically keeping to reject this equal low area. So the support area here, you can see support, 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 support. And at some point the market was supposed to break this area to the downside and go basically what we expect overall is the retest of this long-term trend line. So from a weekly perspective, this is what we have from a weekly perspective. On the daily time frame, what did we have? So on the daily time frame, we had a market that overall had created this impulse to the downside and followed basically by a consolidation period. So impulse and consolidation. And another thing that the market was creating is basically very important that you actually know this, is that overall the market was hitting the Fibonacci levels one by one. And this is a very important thing that you need to realize. If you take your Fibonacci from the high to the low of the impulse, and that is what you're supposed to do, because if you want information on a retracement, you need to take your Fibonacci on the impulse. It's very important to know this. And basically what you can realize is that overall the market went for a retest of the 78.6, then retested multiple times the 61.8, broke all the way below the 32, then hit the 32, and overall the market started to push to the downside. And this is something that is very much expected. The market is supposed to keep creating lower highs, tapping the Fibonacci levels. It's something that you expect from the market to do. And another thing that we had basically on CAD CHF and that convinced us that basically overall it was very probable that the market would break the weekly support to the downside was that hedge funds basically were selling aggressively CAD and they were buying CHF. We can see here that the net positions on CAD were basically the net positions, you can clearly see that went from 21K, then 20K, and then 11K. Okay, we went from 20K net positions to 11K net positions. So absolutely very strong. They closed 7K longs, hedge funds closed 7K longs and added almost 2K shorts. So definitely aggressively selling the CAD. And if you look at what we had for basically a CHF, you can clearly see that we went from minus 22K net positions, minus 20K, and then minus 11K net positions. So basically they added a lot of longs on CHF. So basically you can see that the change is they added 3.5K longs and closed 6K shorts on CHF. So they're selling CAD and buying CHF, meaning that CAD CHF is supposed to make a strong push to the downside. And that is why we basically expected CAD CHF to make exactly this move, and that is exactly what happened. So at the moment we are already basically risk-free in the trade. Now the reason I didn't take this trade on my main account, I took it on a smaller account. Why? For the simple fact that we have a bit, and it's another thing I want to speak about, is that basically we have New Year's Eve this week. So since we have New Year's Eve this week, basically if the market, now everything went perfectly fine, risk-free on the trade, perfect. But what if the market basically started consolidating inside of this at basically the entry area? Then at that point, you're basically forced to close the trade even for a loss, simply because you can't expose your account to the fact that the market is closed on the first. So basically, since the market is closed, the market could open with a gap, okay, so above your stop loss, and in that case, your stop loss is basically not respected, and the trade is closed at the market price at which the market opens. Meaning that you basically are risking more than what you plan to risk. And as you know, risk management is key. You always have to have your risk under control. So it's best to not expose your account basically at these risks. when you have a closed market. That is why it's always best basically to, if you have a situation like this, like New Year's Eve, it happens one in a week, then reduce your risk. Reduce your risk because there is no reason basically to expose your account to a higher risk than necessary. The other pair that we spoke about here on YouTube is USD CHF. Now, what we wanted to see from USD CHF, if you remember from the analysis, we wanted to see USD CHF make a very strong push to the downside from this area of previous support, now to resistance from a daily perspective. And what we had from a weekly was basically a market that overall had created this candle here. Okay, this candle with a long wick here. Now, there is something very specific about this candle, okay? When you see a candle like this, okay, so with basically a red body, okay, and a long wick, or even on the opposite, okay, even a green candle, okay, a green candle with a long wick, with a wick that is at least as long as the body, okay? So when you see candles like this, what you expect is to basically, specifically on the weekly time frame, if you see a candle like this, the next candle 90% of the time will fill in the wick of the candle. Because on the daily time frame, this wick, what it will be? It will basically be an impulse, correction, and impulse. So basically, this wick that you see on the weekly time frame, on the daily time frame, will actually be a correction. And then you will have the continuation that will fill in the wick from the weekly time frame. So this is a very interesting topic, and basically what we expected was continuation to the downside also, because if you look at what we had basically for USD and CHF, what basically hedge funds were doing on the USD and the CHF. So CHF, we already spoke about it. Basically, they were adding longs, decreasing shorts. So basically, net positions were decreasing. So basically, they were buying CHF. So obviously, meaning that USD CHF is supposed to already, only by looking at CHF, go to the downside. But if you go and look what we had from a USD perspective, the situation was even worse, because basically they went from 31K net positions all the way to 11K net positions. So aggressively selling, always selling the USD. Okay, so USD was getting extremely weak. Only with the last reports, they closed 7K longs and increased their shorts by almost 3K. So this obviously led to the basically big push to the downside on USD, and basically that is why we wanted to see on USD CHF this strong push to the downside. Another pair that we spoke about was AUD NZD. Now on AUD NZD, at the moment we didn't trigger the trade yet. Let me explain why. First of all, let me explain what do we have basically from a weekly perspective on AUD NZD. So what we clearly have is a market that has created this information, and after an information you expect the market to make a retracement. Now if you want information on a retracement in the market, you basically have to take your Fibonacci on the impulse, so from the high to the low of this impulse, and what you clearly get is a first level that the market has the possibility to hit, which is the 382 Fibonacci retracement, the first strong resistance that the market will encounter, and we expect the market to hit it. Now, if we go on the weekly time frame, what you get from a monthly perspective, if we go in the monthly time frame, what we get from a monthly perspective is a market that is currently basically rejecting this very strong support area, rejecting it multiple times. And from this level, we expect the market to make a retracement. Why? Also because from a structural perspective, what you expect is basically a market to do something like this. So basically to complete this head and shoulders formation and create the right shoulder, because every time, if you see a market that is basically moving in this way, creates an equal low, then creates a higher high, again an equal low, at that point you expect the market to create the right shoulder and make the push to the downside. So that is why we expect the market to make a retracement from this level. Now, if we go on the daily time frame, what kind of price action we're getting? So on the daily time frame, as you can see, at the moment we have the possibility to create an inverted head and shoulders that could lead to the creation of the retracement that we want to see from a weekly and monthly perspective. So from this area, we want to see the market make the next impulse to the upside, and also we have this clear impulse, correction, and impulse pattern. That is the one that we want to see the market complete. Now, if we take our Fibonacci from the low to the high of this daily impulse, what you can see is that overall the market seems to have created a fake breakout of the 61.8, but keep in mind that this daily candle hasn't closed yet. So you don't know if this candle will close like this or not. Now, what is very important is basically the reason for which we still didn't take our trade on AUD NCD, even though we want to see the push to the upside, is because we didn't have any kind of confirmation on the 4-hour time frame yet for a long. We can see that from this area, the market just kept creating lower lows and lower highs. So the market is absolutely at the moment in a bearish structure, also a bearish environment. I can't tell you how to determine the environment because that is something I keep for the mentorship program together with our rules for entry and other rules for direction that I can't share. But what I can tell you is that overall, from a structure perspective, as you have seen, the market is still bearish. So we can't basically be looking for the long yet. So what we will be doing with the students is basically we will be monitoring price action inside of this area for the push to the upside. And when the market on the 4-hour time frame will provide us one of our valid entries, we will be taking our long to the 382 Fibonacci from the weekly time frame. Another market that we spoke about was the gold market, and we wanted to see basically gold make a push to the downside from this area. Okay, so the market was around here, and we wanted to see gold make the next impulse to the downside for a series of reasons, including the fact that basically we had the impulse correction, the impulse pattern from a weekly perspective. So we expected this impulse correction and impulse to complete. And we also had this previous support and upturn resistance that we expected the market to basically respect. And from a monthly perspective, we had an overextended W formation to the upside that we expected would lead to even a deeper retracement. Now, why basically we weren't interested in the short? Basically, why didn't we take the short? For the simple fact that the market never gave us any kind of confirmation. The market never changed environment and basically also structure, because as you can see, basically the market just kept creating higher highs. Then here it just broke to the upside and exploded to the upside. But from this level, you can see that overall the market just was creating higher highs and higher lows, never really breaking the structure to the downside. Also, this counter trend line here never was retested, and also this counter trend line here never was retested, never was broken, sorry, to the downside. This counter trend line here was never broken to the downside, and the market just kept pushing up and pushing up. And also the environment of the market never changed. I told you I can't share you how to determine the environment, but the environment of the market, I can tell you, never shifted. But you can just, with a simple trend line, you can just understand that the market never broke to the downside. The market just never gave any kind of confirmation for the push to the downside. That is why trading is reactive and not predictive. You react and you need to have a clear set of rules that you're following when you're trading. By having a clear set of rules, you know when you're supposed to enter, which are your conditions for entry. In this case, conditions were simply not satisfied. And this trend line is just one of the reasons for which you can clearly see that the market never shifted to the downside. Another reason for which we didn't take gold is because clearly hedge funds were not interested in the short. So if hedge funds are not selling and you expect the market to go to the downside, it's clear that you have a high probability that the market will not follow the technicals in that particular case and it will break structure. That is why it's always important to basically monitor what they're doing. So what we could clearly see for gold, and it's the reason for which we didn't expect the market to actually break the structure, was that overall with the last report, they added 15K longs and they closed some shorts. Okay, they added 15K longs, so a massive amount of longs. And overall, we went from 270K net positions to 286K net positions. So overall, adding longs, if they're adding longs, unless the market clearly shows you that they're closing them, and you basically see that reflected in the price action, the market will not break the structure. So that was also a clear indication that we couldn't take our trade on gold. I hope you enjoyed the video. If you did, make sure you smash the like button. It really does support the creation of more free analysis and education for all of you, as well as letting me know in the comments below what you enjoyed of the video and just to support me so that I can make more free education and analysis for all of you. If you still haven't, make sure you go check out the mentorship program. It's a very
complete program. You first get all the rules of my strategies, and then you trade them live with me each and every day. And you also get the answer to any question that you have within 24 hours directly on your student dashboard. So make sure you go check it out, and I will see you all in the next video.